Hello everyone, welcome to the Wednesday edition of FreightWaves NOW. I'm Zach Strickland. Today we're going to have Seth Holm giving us an update on Q2 earnings, but first we're going to toss it to Dean Croke, who's going to give us some insight on what's happening with Intermodal.
Hey,
Dean,
Zach.
what you got?
Yeah, today the American Association of Railroads released their weekly numbers, and of interest today, carload volumes are up about 2.8%, about 7,272 carloads this week, so it kind of defies the overall trend. Intermodal units are up about 0.5%, only about 1,200 more intermodal units moved this week, but the general trend overall is still down. So year to date, carload volumes are down about 3%. Intermodal volumes are down about the same, so the trend is still down as we head into the busy retail season.
So year over year it's down?
Year over year it's down, year to date it's down.
Okay.
The big mover is trailer on flat car because it's not a very competitive lane for railroads now or motor transport now because of the overcapacity in the truckload side. So
Okay.
trailers on flat car have moved back to the road side. They're down about 18% year over year. The big movers this week are things like coal is down, agricultural products are down in terms of volume. The volume is up this week because of chemicals and petroleum products. What's interesting is that coal and agriculture represent about 45% of all total carloads in the market.
Coal's a big part of rail
Big
volume,
part,
is it
but it's
not?
declining.
Yeah, historically over the last several years, right?
Right. So if you think about the West Texas Intermediate crude price, all of the activity in the Permian Basin, carloads for chemicals and petroleum products are actually increasing over time. The big mover this week was sand. Fracking sand in particular was up about 9% in terms of volume. So even though the trend is down,
Wow.
there are some parts of the market where volumes are up. Now, the part of the market I wanted to have a bit of a deep dive into today is the intermodal market, in particular the Los Angeles market. So if we could have a look at the next chart, what you'll see is a very interesting relationship between the tender rejection rate on the Los Angeles-Chicago lane and the spot price for intermodal rates on the same lane.
What are we looking at here? What do we have on the lines? Tell us what the lines are.
So the dark blue shaded background is the dry van outbound tender reject index, which you can see here when we had the busy period, the pull forward of pre-tariff freight before January 1, tender rejection rates are up in the much higher range, about 10 times higher than they are today. Right now they're down around 2.17%. So carriers have not a lot of optionality in the market, so rejection rates are low. But what's happened here is the intermodal rates have dropped about $1 per mile over that same period of time. They've gone from up here in the $2.50 range, they're right down around $1.22 a mile now.
So you're saying that the van tender rejections are actually correlated with the rates in the intermodal market?
Because long haul trucking and intermodal tend to compete heavily in the 850 mile plus range, which is our long haul outbound tender reject index. So when you look at that specific lane, what's important about this from an intermodal perspective, this represents about 25% of all national intermodal volume on this one lane.
Oh wow.
Los Angeles, Chicago. So if you want to take the pulse of the intermodal market, this is a really good one. And what you see here is a lot of price competition between long haul trucking and intermodal. Long haul trucking's at about $1.44 a mile for solos, maybe $1.75 a mile for teams. Intermodal volumes are down around $1.22 right now per mile. So I think what's going to happen is capacity increases on the West Coast. We're going to see a lot more tightness, a lot more competition in pressure. I don't see a lot of upward movement in intermodal rates in the short term because of the extra capacity on the West Coast.
So it's going to be a soft third quarter, you think?
I think the Q3 will be soft.
Okay.
Retail season for intermodal should be starting around now, so if there was an uptick in volume and the opportunity to increase price, it should be happening shortly, which is what we'll be watching in the next week.
All right, good deal. Thanks, Dean. All right, and now we got Seth Holm to talk about financial markets. Seth, what you got?
Thanks, Zach. So we're about halfway through Q2 earnings season. About 50% of companies have reported so far, and on average, revenue is tracking slightly up year on year. However, earnings are tracking down 3% year on year.
Down, okay. So has it been a rough Q2 or?
It has been. So the reason why this matters is this is the second quarter in a row. So anytime you have 2 quarters in a row of negative earnings, you have what's called an earnings recession.
Oh dear.
Yeah.
That sounds rough. Is that as dramatic as it sounds?
Well, so there's 2 things. Right now, there's 2 things really having a negative outsized impact on companies. One is the trade war, and 2 is the strong U.S. dollar. So of the companies that have 50% or more of their revenue from abroad, those companies are reporting really weak numbers, down 14% year on year for earnings versus down 3%. Now, in terms of whether the earnings recession actually matters or not, I looked up the data and I went back. There's been 12 of those since 1950. And the crucial distinction is whether or not that earnings recession is accompanied by an economic recession, because if there's an economic recession, you get a lot more downside in the stock market.
Right on. So what do you got for us on the chart back here? How are you going to tie that together?
So this chart today, I've got bond yields, 10-year bond yields in orange, plotted against the S&P 500 in white. And given today is Wednesday, we're going to have our first rate cut from the Federal Reserve in 11 years. The market's looking for a 25 basis point cut. And so what I wanted to show here is that right now you have this big divergence. If you look right here where it opens up on the right-hand side, typically you have a positive correlation between bond yields and the S&P 500. And the logic is when bond yields go lower, that suggests lower economic growth. So you wouldn't, given the fact that we're reporting an earnings recession, so far at least, you would expect the market not to be at all-time highs. So what I think is if the Fed, what's going to be the big deal here is whether or not those Fed rate cuts have the stimulative effect to the economy or not, because if they don't, then I would expect that positive correlation to eventually return. And basically, if bond yields continue to go lower, I would expect the stock market to go lower with it.
So you think this is kind of an anomaly in the overall market? You don't think that it's going to signal a big recession or anything like that?
Well, so they're both forecasting different things. The stock market is forecasting a strong economy, and the bond market is forecasting a weak economy. So that's why it's an interesting chart.
Okay.
And that's why we're going to continue to watch this.
Very cool. All right, thanks, Seth. And thanks for tuning in. Be sure to subscribe and check out all our social media. And everybody have a great Wednesday.